What's up, everybody? Hey, it's Mike Whitworth, Expansion Real Estate Group. Happy Friday to you, and welcome to this month's edition to the monthly market update. We are smack dab in the middle of October, and really good news is we're like 26 days away from this election stuff, and hopefully after November 5th we can move on with our lives and things can move forward. So before I jump into the stats today, just a quick shout out to all my Minnesota people, and 5-0. 5-0, baby. We got to take advantage when we can with the Vikings fans here. So, all right, let's jump into our stats and see where we're at this month. All right, here is our Cromford Market Index for the last 24 years. And a bit surprising, the market dropped a little bit this month. So we ended off last month at 99.3. And right now we are at 94.8. So we've had about a 4.5 point drop in the index. And then today we're seeing at 94.4. So since the beginning of the month, only a 0.4 drop, but a decent sized drop over last month, which is, we weren't really expecting that, with the Feds cutting the rates and things like that. It was a little bit surprising, but we look here on our daily chart and you can see it just kind of it stayed pretty steady down. And looking at, this is actually a better view. So this is our weekly chart for this year. This gives you a much better picture that realistically, 8 out of the 9 months of this year, the market has been in a pretty steady decline, right? I mean, that's a dramatic drop the entire year, and it hasn't really changed. We thought maybe in August it was going to start to turn around, but it has not found that bottom yet where it's turning around. So, what's causing that? The biggest thing we've talked about is supply and interest rates and the buyer's demand. And the supply took a big jump up from month over month. So last month we had 14,604 active listings, and this month we have 15,781. That's an 8% increase in inventory. And it's been 12% from 2 months ago. And this year we're up 32% in the overall inventory. Again, numbers are pretty low, right? Overall. So we still have a low inventory, but from January to this year, at this point this year, we're up 32% in our inventory. So that's a big difference. It's a lot more choices for buyers, and the buyers just haven't came out of the woodwork yet. They're just, with the rates still, fairly high, they just haven't made that decision that, this is the time to buy. And so we're just seeing that inventory rise and rise and rise. And I think over the year, you've heard me say this, even the last couple of years, I keep saying this is one of the weirdest markets I've ever experienced. And, this is my 24th year doing this. You would think with this Cromford Index dropping the entire year that we'd be losing value in our home. But it's actually the opposite. Our prices have actually went up 4.5% since the beginning of the year. If we look back here in January, our median average sales price, again, this is the entire market of Phoenix, was $435, and this month we're at $455. So we actually have basically a 4.5% increase in values across the board at the same time when the index is doing this. And remember though, I've talked about this over the years too, this market index is a leading indicator and prices kind of follow. So it'll be interesting to see what happens here after the election, what interest rates do, to see where these prices go. Are we going to continue to trend up, or will we see a little bit of a correction in prices? So we don't know that yet, but all we can do is keep on following the stats and following along. So one thing I wanted to kind of show you today was a little bit different today. I want to talk about, it has to do with interest rates and the Fed and, the economy and everything that kind of drives this whole thing, because I really do believe that the interest rates are going to be the biggest factor that's going to turn on the green light for the buyers. Once we get to a certain point in rates, the buyers say, okay, I'm ready to go, and they're going to jump back in. So if you remember last month when we talked, the Feds, it was right before the Feds were going to cut the Fed rate by either a quarter point or a half a point. And they ended up cutting the rate by a half a point, which was bigger than people expected. So we were thinking when that happened that that's good for interest rates, that they're gonna follow the way down. But in trading and in the dollar, like the US dollar value, and even in crypto, there's a saying called buy the rumor, sell the news. So we've been talking about this rate cut for a couple months coming into it. And you can see this U.S. Treasury bill here. This is what really drives the interest rates. It's this U.S. 10-year Treasury and interest rates over the last 35 years. They move in similar directions, almost exactly. So for a couple months up to the Fed rate cut, they dropped the rate, dropped the rate, dropped the rate, dropped the rate, and then in September, after the rate was actually cut, they changed direction. So they priced in the price cuts all the way up into it, and then once that happened, they actually corrected a little bit. So interest rates have actually went up since they've cut about almost a quarter of a point. And one thing that drives that is the two things that the Fed cares about is jobs and inflation. You hear that all over the news. Those are two major things that drive this economy, and what determines whether the Fed's going to cut the interest rate or raise it. It's jobs and inflation. And on October 4th, we had really, really positive news in unemployment. The rate actually the unemployment rate dropped. Again, as the Fed wants to see, this sounds crazy, but the Fed wants to see unemployment go up, where businesses are struggling, they're having to lay people off before they decide to cut the interest rates. So this was a major change, and this non-farm payrolls is one of the biggest indicators every month, and they were way off. They expected 125,000 increase in pay, and it was actually 223,000 jobs had more pay. They were way off in their estimate there. So those two things caused the Fed to basically slow down. And then just yesterday, CPI, inflation, right? Jobs and inflation. So inflation came out and the readings came out and inflation went up. That is not good for interest rates because, again, the Fed won't cut interest rates until they feel like they have inflation in control. And they want to see inflation around 2%. So it is actually at 2.4. They were expecting it to only month over month go for 0.1%, and it went up 0.2%. Year over year, they're expecting it to be 3.2% over, and it's 3.3 over. So those are positive readings as far as for the dollar value, which means they're less likely to drop the rates. And you can see here what coincides with this 10-year Treasury. If we look at the actual mortgage rates, we came down here right after they cut, and we were sitting around almost at 6%. And we had the feeling like, hey man, in the next couple weeks, we could be in the 5%. Once that positive data came out, the rates jumped up. So today they're at 6.32. Again, a whole 0.25% higher than they were. And then with the positive news yesterday, we very well could see these things continue to rise up. So just a little bit of data, I'm kind of a numbers geek, so I find that stuff interesting. I think it's interesting when you watch the news, you'll start to hear them talk about unemployment and inflation, and you can kind of correlate that with what housing rates might do as well. So last thing here today, guys, I just want to really thank you guys. I've had a number of you guys have just messaged me on this and just want to talk about the market. Again, this is what I do 24 years. I love doing it. So if you have any questions at all about your house, about the economy, about the market, I am here to be your trusted advisor and would love to chat. All right, have a wonderful day, have a wonderful month, and we'll see you next month.